Dear friends, welcome again to the monthly video on markets and investing. And what a month it has been. May was indeed brutal for equity markets. We saw a deep correction in the broader markets, and while the correction in the Nifty may be in single digits, several mid and small cap stocks across many sectors had large corrections of up to 20-25%. Obviously, the news flow has not been very benign. We have concerns on inflation. We have concerns on crude prices. We had concerns on interest rates going up. And we have the war between Ukraine and Russia, which is still on 3 months, and we don't know when it will end. And despite all these challenges that we've seen, as long-term investors, we need to focus on substantive issues because sentiment can be good or bad. Flows from foreign institutional investors were significantly negative. But amongst all of this, do we see a silver line? And what matters at the end of the day to markets in the long run is only one thing, which is earnings. Now that the full year is behind us and the fourth quarter earnings are already out, it would be important to sit and assess what the numbers tell us and cut out all the noise and the sentiment and look at the substantive issues that matter when it comes to long-term returns in markets. As you know, that our bull case on the Indian markets now for several months and years has been our conviction that earnings in India have bottomed out and we are likely to see a very good, healthy, double-digit compounding in earnings. And several months ago, I had mentioned this, that corporate earnings to GDP had bottomed at about 1.9 to 2%. And then post-COVID, we have seen a very, very smart rise in earnings. Does that still hold true? If you look at the NSE 500 companies, which is the Nifty 500, which is a broad index of several sectors put together, I would say that the fourth quarter was reasonably strong, despite the fact that we had Omicron in January and early part of February, and things only started to stabilize from March onwards. Having said that, if you look at the top 500 companies in the country, what we see is that earnings or revenue grew by 20% YOY. And yes, margins took a little bit of a knock. But despite that, we had EBITDA, which grew at 23% year on year, and PAT for the 500 companies in the fourth quarter grew by 30%. Now, if you take the full year, which is 21-22, the year that went by, revenue grew by a healthy 24%. Obviously, a large part of this 24% growth that you see in revenue is also because we've seen the impact of inflation and companies taking price hikes across the board. And if you take the full year, you will see that revenue grew by 24%, EBITDA grew by 22%, but PAT grew by 53%. Yes, basically in the year 21-22, the breadth of the market delivered a 50% plus earnings growth in NSE 500. What it tells you is that the earnings picture in India for the last 2 years has been very, very strong. And therefore, in our view, the underpinnings of this market, despite all the other factors that we spoke about, is standing on a very strong fundamental pivot of earnings, which gives us the confidence that if the earnings are there, even if the markets correct for various macro headwinds that we spoke about, the markets do have the inherent ability to come back because we do have earnings support. But what has happened to consensus earnings for next year, because markets are not about history, markets are about the future. So if you look at FY23 and 24, what we find is that despite the macro headwinds, consensus estimates were brought down sometime during Feb when the war started, but post that they have stabilized. We haven't seen too much cuts to earnings on the Nifty for FY23 and FY24 right up until June. I think we believe that now earnings cuts have fairly stabilized. Again, that gives us the confidence that unless and until we see significant further disruption to earnings, we believe that the earnings trajectory will continue to be strong. In fact, consensus earnings growth for FY23 as they stand today after the cuts still continue to be in the range of 16 to 17%. Having said that, we are also seeing that other than oil, most other commodity prices have started to soften. Obviously, the government has taken certain preemptive steps when it comes to steel, when it comes to food grains. We have seen that there is a clear attempt to cool down inflation. And as I said, while higher crude oil prices continue to be a worry for India, most other commodity prices for now seem to have topped out. And that gives us the confidence that earnings will continue to be resilient, and hence the markets will also continue to be fairly resilient. Now, last month, we spoke about two sectors in detail. We spoke about the banking sector, which we said will do very well in 23 because we will see that provisions will taper off, and we will see that is one sector which will contribute significantly to earnings growth in the coming year. And we spoke about the IT services sector, where we believe that the spending in technology is more structural. However, in the recent times, there has been a worry that if US growth slows down or if there is a recession in the US, growth in IT might taper off. Our view is that, well, it could happen, but we still believe that that's a sector which we should remain invested in, because we do believe that at least for the next 2 to 3 years, we see a structural tailwind in technology spending, and these businesses do not require incremental capital. They are highly cash generating, they are free cash flow positive, and the companies have also started increasing their dividend payouts to shareholders. But this month, we will talk about two other big sectors. One, which is FMCG or consumer staples. And we did mention last time that consumption is definitely hurt at the bottom of the pyramid, because people where incomes are low are definitely feeling the pinch of higher inflation and prices which have gone higher. And if you look at the data for FMCG, you will see that from Q1 of last year right up to Q4, every quarter, the year-on-year growth has been decelerating. So from 18% in Q1, we were down to 12%, then down to 11%, and again down to 11% in Q4 of this financial year that just went by. If you look at operating profits, that has decelerated from a 12% growth in the first quarter down to 5% growth because it's really impacted the margins. And finally, PAT has grown at 9%. So what we are seeing is that in the staples or the FMCG sector, the top line growth and bottom line growth is slowing down. And therefore, we believe that growth is not very exciting. However, this is a sector that people generally go to when there is extreme volatility in the marketplace because they find safety in many of these FMCG companies. However, as you know, we are growth investors and we like to invest in companies where there is a structural earnings growth story. And while FMCG company growth, profit growth may revive in the next 6 to 9 months on the back of higher agricultural product prices and the fact that the economy is opening up, the cash flows at the bottom of the pyramid should improve, we still believe that the risk reward is not very appealing or exciting. And actually, if you see our bet in the consumer staples business or the FMCG business has been largely in companies which are more tuned to the opening up of the economy. So for example, we have investments in United Spirits, where instead of a single digit growth in other staples companies, we believe that there will be an 18 to 20% earnings growth in a company like United Spirits. So FMCG, we believe, will be in a low growth phenomena, though growth may improve. And our bet there has been in companies where we think growth will be better than the averages. The second sector that I would like to talk about is the auto sector. And that, in our view, is very, very interesting because the auto sector really has done nothing for the last 4 or 5 years. There were many headwinds in the auto sector. There was a change in regulation from I think somewhere in 2018-19, and therefore volumes didn't pick up. We also had a problem, the NBFC crisis, so funding dried up, and then we had COVID. Now, finally, after several years of struggle, we are seeing that the auto sector is likely to revive as the economy opens up. And this is a high operating leverage sector. There is disruption of electric vehicles that is happening there, but many of the auto companies, whether four-wheelers or two-wheelers, are adapting very quickly and are likely to benefit from the growing electrification of transportation. Having said that, if you look at the auto sector numbers, right? In Q1, you had a minus 25% revenue growth quarter on quarter. From there, we moved to a plus 10% revenue growth quarter on quarter. EBITDA has also grown substantially, and we have seen that from negative, the sector is now has a positive EBITDA, and if you take a year-on-year EBITDA growth in the fourth quarter, it was almost 120%. Yes, margins you would expect because of higher raw material prices, higher steel prices would have actually gone down, but surprisingly, if you look at the margins, margins have actually improved from 8% in quarter 1 to 11% in quarter 4. Recently, we have, through the last couple of months, increased our exposure to automotive, and increasingly you will see that we will have a higher allocation of names of this sector in the portfolio, because we believe that there is pricing power with the automotive guys, that despite raw material prices going up and chip supply constraints, what has happened as a result, despite volumes not growing, what has happened is that these companies are able to jack up prices and substantially improve the margins. So it is quite counterintuitive that these companies have actually been able to improve margins despite lower volumes and despite supply chain problems, because they've aggressively taken pricing up. Now this year in 22-23 and onwards, as the chip supply shortage eases off slowly and steadily over a period of time, we believe that volumes will also pick up. And as the agri economy picks up because of higher agricultural product prices, we believe you will start seeing a massive revival in two-wheelers. In four-wheelers already, especially in categories like SUVs, we do see that the waiting period continues to be significantly higher, that demand is running higher than supply. And therefore, this is one sector where we believe that there could be substantial tailwinds going ahead. As the chip supply shortage tapers off, volumes will improve. And as and when the situation in Russia and Ukraine stabilizes, which we don't know when, it is quite possible that oil prices could also come off. And if that happens, there could be a big tailwind that could come through to this sector. Obviously, the risk remains that if things geopolitically become even more bad, and if oil prices go beyond $120, you may see demand getting impacted. But we do believe that if you take at the overall risk reward over the next 2 years, we believe that this is one sector that we would want to be invested as opposed to FMCG. We think that discretionary and auto will be a great sector to look at. So with that, I end this month's communication. We will continue to talk about things which are important from a market and earnings perspective. Till then, thank you. Bye-bye.